Hi, my name's Matthew Boersen, and I'm the Managing Partner of Straight Path Wealth Management. Today we're going to talk about another common question that we get from retirees, which is how should my investment strategy change when I get into retirement? And the reality is it should absolutely change, because as you're transitioning to the retirement phase, you're moving from what we call accumulation to the distribution phase. You're going from saving and building up this asset to needing now to turn it into a consistent income. And one of the big risks that we face in the distribution phase when you're in retirement, comparative to what we faced when you were in the accumulation and saving phase, is we now run into something called sequence of return risk. And that's the concept that the stock market doesn't consistently churn out the same return every single year. It doesn't return 7%, 7%, 7% every single year. Instead, what it does is it'll have great years where it returns 28 or 30%, and then it'll have years where it drops and loses 14%. Those swings didn't matter quite as much when you were in the saving and accumulation phase. But those swings in the sequence of returns does matter when we start getting to the distribution phase and you start taking money out of your accounts. And if we're not careful, a 30 or 40% drop in the market at the wrong time, if you're not invested correctly, can have dire consequences to your retirement plan. And so our recommendation to our clients is to start transitioning to a somewhat distribution-focused strategy at least 7 years before you get to retirement. And so this is not something that happens the day that you retire, that you shift your investment strategy. Instead, this is a slow build-up process that starts happening years before. We recommend 7 years because by and large, that allows the market to have its volatility, but to have a long enough time period where the market typically will recover and still elicit a positive return. And so what this typically looks like is that over the 7 years, you're shifting to more conservative investments that are not as reliant on the stock market to provide a return. And again, our specific recommendation is to always be looking at the next 7 years of income needs and making sure that we've got that money set aside into safer investments. Generally speaking, safer investments for us means things like cash and high quality bonds. Some people will talk about using dividend paying stocks to create income in retirement, but academic research doesn't lend a lot of credence to that. Because what happens with dividends is during economic downturns, right when we need those dividends, right when we don't want to sell stock to fund distributions, typically dividends can be cut. And so dividends are not a reliable and sustainable way across economic cycles to develop retirement income. So that's why we typically will focus on bonds and cash to provide much of that income. And we want to make sure that we've always got enough runway where we can get past short-term market volatility. And that's why we typically will start shifting money within a 7-year time frame. So starting 7 years before retirement, looking out 7 years and making sure that we've always got enough money set aside. So as an example, what that could potentially look like is if you're 3 years away from retirement. If we look at the next 7 years, we've got the first 3 years where you're still going to be working. We don't have withdrawal needs out of the retirement account, so we're okay. But the next year, year 4, 5, 6, and 7, we know that you're going to have to start taking withdrawals because you're going to fully transition to that distribution stage. We'd want to calculate how much money is going to be needed out of that account for the next 4 years and make sure that at least that amount of money is set aside into cash and bonds. What that naturally implies then is as you get closer and closer and closer to retirement, we're going to shift to a slightly bigger cash and bond allocation inside your account. So when you actually get to retirement, we're going to have 7 years worth of distributions set aside into safer accounts. So that's a general kind of overarching concept of how we think about income planning, how we think is a better way to invest for retirement, both from a financial standpoint as well as a confidence standpoint for you in retirement. Because we see a lot of retirees get to this transition point and then become very nervous as they start taking money out of their accounts and start to see the stock market wobble a little bit. So if you want to talk about specifics on how we execute this strategy, how we do this for our clients, and what this can mean for your retirement and your confidence inside retirement, please don't hesitate to reach out to me or my team. We'd love to walk you through our process of building retirement portfolios and making sure that that fits your needs. And even if you've got a couple years until retirement, it's still important to start early. Again, we recommend starting this transition phase about 7 years before retirement. So it's never too early to reach out to say, hey, what do I need to do? What do I need to keep my eyes on? And we'd love to walk you through and answer some of those questions.